It's time for the Phil Ferguson Show, only on Secular Media Network.
Well, hello, everybody. This is Phil Ferguson, and you are listening to The Phil Ferguson Show. This is show number 175, and I am taking some time out of my 4th of July, probably hit the grill right after this, to record a segment. It'll probably go up the next day on July 5th, but when I get it all mixed down, we've got a lot to cover today. Later in the show, we are going to talk to Anthony Magnabosco. He is making videos, performing street epistemology, where he goes out and asks people, what do they believe, and what do they believe without evidence? What do they have faith in? And they can pick anything they want, and often they pick religion, particularly Christianity, because he's doing this in the United States of America. And then they have a nice conversation where he goes about trying to show them via questions so that the person who's interviewed does the thinking. It's fantastic. I think you're going to really love that. Another thing that we're going to talk about here in a few minutes are market returns. We're going to talk about the results from the last year, 3, 5, and 10 years as of June 30th, 2016. I try to do this every quarter, although every once in a while I skip a quarter, so I'm making sure I do it here at the midpoint of the year. And we're going to talk about some of those returns. And, of course, before we get into that, I want to tell you a little story. It's something that I was talking to one of my clients about, and they said, Phil, I don't think I've ever heard that on your show, so we're going to talk about that. I had one of those moments where a friend came to me and said, Phil, I wanted to let you know that I followed your advice. And that's always one of the scariest things I can hear, because often when they say they're following my advice, I know that they're not, because they hadn't talked to me about it, because that's one of the pieces of my advice. Talk to me about it. But this was back in the late 90s, even around the time frame of 2000. And I had been talking to them for years, maybe even close to a decade. This was a person who had about $400,000 or $500,000 in jumbo CDs. And so a jumbo CD is $100,000 per CD at the bank. And these jumbo CDs were paying a couple of percentage points, and they were rocking along doing this for a long period of time. And I had suggested that they should have some of the money in the stock market for the long run, not making 2, 3, 4%, but theoretically 10%. That's what the market has returned, at least S&P 500 over the last 46 years, and you can look that up on Wikipedia yourself. So when they said that they'd followed my advice, I get this little tingly sense, that my little spider senses are like, oh my God, what did they take that I said, perhaps out of context, and do? And so I asked them, and he said, I sold all my jumbo CDs because I met a guy. And of course, that's always what you want to hear. Right? I met a guy, I know somebody who happens to be a broker, and they sat down together and picked 20 high-tech stocks. This is not what I was suggesting in any way, nor have I ever suggested that you take all of your money that's safe and conservative, especially if you're someone who's terrified of the market, and pulling it all out and going to 100% stock the next day. It's something that if you're really worried about, you might want to ease yourself into. It's a long-term process because things can happen. The other thing that this person didn't do is they didn't invest in the total stock market as I would have suggested, or at least broken it up in different sectors, and some in bonds, some in U.S., some in international, that kind of thing. They put it in 20 specific stocks, and all 20 of them were high-tech.com type stocks. Yes, that's right. You heard me right. We're talking about 1999, early 2000. They put $500,000, let's just call it $500,000 into 20 .com stocks. So there was not diversification there, and you're in a market segment that was on fire. Matter of fact, the NASDAQ, over a period of about 10 years, and I'm going to look here from 1990 was about 330 was the NASDAQ, and by the spring of 2000, it was 3,800. So it was up about 12 times in a decade. 12 times. The rule of 72s tells us that in a decade, you might go up on average 120, 140, 150%, maybe 200%. The most that the U.S. stock market has gone up in a 10-year period is 490%. And the NASDAQ, though, which is a much smaller index, went up 12 times, not 4 times, not 3 times, not 2, 12 times. That's something that should give you pause before you want to put a whole lot of money in it. And as an example, during that same time frame, the U.S. stock market, again measured by the S&P 500, I'm going to go back to 1995, went up 37.5. 96 went up 33, 97 went up 33, 98 went up 28, and 99 went up 21%. And during this time, because I have been doing this, since before that time, when I was very small and a few clients that I had, we started gradually moving to safer investments. And thankfully, somewhere in late 99 or early 2000, my memory tricks me, we went to about 80% cash. But it was a gradual process because one good year, 95, where you make 38%, that's phenomenal. That's the single best year in the last 46 years. And you're very excited about that. And you're happy. And you don't want to change much. The second year, we made 23%. And you start thinking, okay, that's 2 years of really, really massively huge returns. That's great. But it starts to get me a little twitchy. So maybe someone close to retirement would say, you know what? Let's go ahead and build the cushion early. You made 50, 60% in 2 years. Let's not be stupid. Let's go ahead and fill up the cushion now, even though you've got 5 years to retirement. For someone who's younger, might not worry about it so much. Maybe we hedge out 5 or 10% out of the market. Maybe some more bonds, maybe some more real estate. There's all kinds of different things you can do. Then we get the third year where you make 33% again. And now you're looking at maybe getting close to 80, 90% return in 3 years. Not reasonable, not realistic. So you move some more money over and now maybe even take a little bit of a defensive position. And unfortunately, you start doing that. You get 5, 10, 20% of your money not in the U.S. stock market. You make another 28, 29%. And now you start looking silly because you've taken money out and the market's going up like a rocket. But now you've had 4 years of 23% plus. So I go to even more cash. And then we get a fifth year of this. And now we've moved all the way down to 70, 80% cash or bonds, short-term bonds, different types of bonds, real estate, and thinking this can't continue. The U.S. stock market makes 10% a year in the long run. Of course, it depends on what dates you pick and how you slice it, but I'm talking 20, 30, 40, 50, 100 years. It cannot make 20% plus per year. And one of the triggers that encouraged me to get more money out of the stock market was this guy that came to me and said, Phil, I finally followed your advice. My advice was not ever to him or anyone to take all of your money out of CDs and just jump into the market after 5 years of massive growth. You have to use a little bit of common sense. Yes, I'm buy and hold, but I have my limits. I usually don't. It's one of those things my wife and I debate. I consider myself to not be a market timer, but I do make market-based adjustments. So when things get out of whack by a lot, you got to start paying attention to that. So I told this guy who put all this money in these tech stocks to get out, to put it back in cash. And he goes, well, I've just lost 5% in the last couple of weeks, so I don't feel comfortable doing that. When I get my money back, maybe I'll get out. And I said, I don't know that that's going to happen, because this is when the .coms and pets.com, which he owned, started having problems. And the NASDAQ in a very short period of time fell from a peak of close to 5,000 down to around 1,300. And he comes to me and he says, all right, Phil, I sold everything. And I'm like, oh my God, man, you bought at the top and you sold at the bottom. Now, we didn't know at the time that was the bottom, but it had lost 2/3, 3/4 of its value. So he sat in super safe investments, making 2, 3, 4% a year for over a decade. And then within a year or two, lost half, 60% of his money. And he said, Phil, I'm never going to try the stock market again. And it's one of those things that I tell people all the time, and I love to quote this famous poet, at least in reference to the stock market. There is no try, there is only do. You do not try the stock market. And it's one of those things that when someone calls me and they say, hey, Phil, I want to hire you. I want to try the stock market for a few years. I tell them, no, you cannot hire me. That's not what I do. I don't try the stock market. I invest in the stock market. The NASDAQ today is $4,800. If he'd left his money in, he would have gotten it back eventually, but he would have been much better to dollar cost average in. We've talked about that before. And that can take some time, but if you're already invested, you don't want to jump out or jump in. You want to make gradual adjustments that might take weeks, months, or years, depending on how sensitive you are to it. But if you're a long-term investor, 20, 30 years, and even if you're 60, we're hoping, we got our fingers crossed, you're going to live 20, 30 years, or even if you're pretty sure that's not going to happen for you, you might want to leave the most money you can for your descendants. Now, if your attitude is fuck your descendants, well, then we can talk about possibly a different strategy for you. And that's one of the things that makes all of this unique. So now what I want to do is go over some of the results as of June 30th of 2016. The first thing I want to look at are things that might be in the cushion. These are short-term bonds. This is what I'm focused on right now. And government bonds in the last year have made 2.5%. And corporate bonds have made 3.2%. So that's what you can expect to make. Over 10 years, both of those types of instruments have made between 3.3 and 3.7%. So that's the kind of return you can expect from short-term bonds. Amazingly, in the last year, something that I'm telling people not to invest in is intermediate and long-term U.S. bonds. And there's a reason for that. And the reason is that long-term interest rates can go up. And if they do, a long-term bond portfolio can lose an awful lot of money. Well, the Vanguard Long-Term Bond Index Fund, at least in the short term, has shown me to be a fool because it has returned almost 16%. So you could be in the Vanguard Long-Term Bond Fund over the last 12 months and you could have made 16%. The amazing thing is the vast majority of that came at the very end of the quarter, late in June. And one of the reasons I think that happened is because of the fear over the Eurozone and the UK leaving the Euro. So you have a flight to safety. And what the flight to safety means is that more and more people than ever are terrified of putting their money anywhere else in the world that is not the United States. So when someone tells you that the United States is not safe, a good place to invest, or that the U.S. government bonds are not good, they are in the extreme minority compared to every other investor in the whole fucking world. Where else do you want to put your money? Do you want to put it in British banks right now after the vote, the Brexit vote? Do you want to put it in Italy? I mean, I love Italy, but I'm not going to give them my money. It's a nice place to visit. I might live there someday, but only after I have all the money I need. Do you want to put it in South America? Do you want to put it in Brazil, where they just ousted the president? Do you want to go to Japan or China? I mean, China lost 50% in 6 months. Of course, that was after a 100% run-up. But their stock market is fiction. Ours has problems, no doubt about it. There's fraud, there's embezzlement, there's cheating, there's lying. But it's the best system, the most clear system. And as long as you can avoid some of the really bad stuff, you got a fighting chance. Where in a lot of these other countries, you're literally rolling the dice. And that's not necessarily bad. You don't want to do that with your entire portfolio. So people are rushing into the safety of U.S. bonds because that's the safest place to invest your money anywhere in the world. So in the short run, you made a surprisingly large amount of money in the Vanguard Long-Term Bond Index of 16%. However, these long-term bonds have a current yield of 3.3%. 3.3% is what you should expect in the long run over the 20 years that the bond pays out. Because if you buy a bond straight up, just a bond, and it pays 3.3%, you will get the 3.3%, and eventually, 20 years later, they'll buy back the bond. You cannot make 16% on bonds that pay 3.3%. That's just not how that works. So this rush of money coming in drove down the interest rates because people bid up the price. So if you have had any second thoughts about getting out of intermediate or long-term U.S. government bonds, now is the time. Take your profits and get the fuck out. when interest rates start to go up,